Expert advice is coming your way in the realm of mortgage insurance. Kevin Hearden from MGIC joins us to explore the strategic considerations lenders must evaluate regarding MI activation and coverage for construction loans. Any information provided by Kevin during this podcast is for education purposes only, and any opinions expressed by Kevin during this podcast are solely his and do not necessarily reflect the views and opinions of MGIC.
Are there any mistakes or pitfalls you see, lenders ever making when they strategize around mortgage insurance and when to get it, when to activate it?
In terms of my experience with lenders, it's understanding that portion of how what the MI benefit is for the construction phase.
Are there any situations, where MI would be added or you could add voluntarily, after the loan is closed?
Generally, it doesn't function like that.
Any other trends that you see happening? Are there any industry trends or regulations or things that are happening in the MI space that our audience should be aware of?
Yeah, I mean, there's stuff always happening, right? A couple things in particular that we've been paying attention to is recently this NAR, National Association of Realtors settlement.
I'd like to welcome everybody to the Construction Lending Podcast. I'm your host, Sean Ferris with Lang Grill, and today we have a special guest, Kevin Hearden with MGIC. And Kevin, you are the Director of Product Development at MGIC. Welcome to the podcast.
Well, thank you so much. So glad to be here.
Now, we've had many conversations with MGIC, and I am by no means an expert in mortgage insurance and what you guys do over at MGIC, but I know just enough to get myself in trouble. But before we dive into all kind of the nuances and everything everybody needs to know about mortgage insurance, can you tell me a little bit about yourself and your background and how you got involved with MGIC?
Yeah, happy to. I've been at this business for a little while now. Not just MGIC, it's about 8 years at MGIC, but prior to that, about 25 years working on the lender side. So it was primarily with banks of varying sizes, and had a number of different roles. The last 10 or so were capital markets, secondary marketing, product development, kind of rolled up into me. But I different jobs like many of us over the years, did some underwriting, correspondent lending, a number of other things. So years are starting to add up. And I came to MGIC, just it was the right opportunity, I think, for myself and the organization. It's been an interesting ride for 8 years. And I thought, 25 years into this business, I kind of know a few things. There was a lot more for me to learn in the MI space. Hopefully I can share some of that today.
Yeah, it's amazing how big the mortgage universe is. And then when you really start thinking like, I got this thing understood. I know what this thing is. Along comes this completely new change or thing and, really expands it into something you never imagined. Well, tell me about MGIC. What does MGIC even do?
Yeah, so MGIC stands for Mortgage Guarantee Insurance Company. So we are a lead mortgage insurer. So there are several mortgage insurers in the space. We actually, I'll say, invented the industry. That's an accurate statement. Back in 1957, MGIC was the original MI company, a gentleman by the name of Max Carl. We could go on a bit more about that, but we'll focus a little bit more about what we do, which is we insure mortgage loans, and that insurance basically protects lenders in the event of default. I think in the marketplace, if you ask a consumer today, maybe a home buyer or someone who's getting a loan, like what is mortgage insurance, you'll probably have, I don't know, or you might have, it's something I want to avoid, or if I have to have it, I want to get rid of it as quick as I can. I joke sometimes and I say, well, you probably don't have a lot of borrowers as a loan officer showing up at your door and say, give me some mortgage insurance, and the more, the better, right? It's well, really the other side of that, and really the important part is through mortgage insurance that facilitates lower down payments, which means borrowers get into homes sooner. And, home ownership is, I think, pretty broadly recognized as the number one tool for wealth accumulation for individuals in the U.S. And so if you can get in with a 3% or 5% down versus saving for 20% down, that's certainly an opportunity that many millions of borrowers want to take advantage of. So a little bit more specifically, in the event where there is a foreclosure because the borrower is unable to pay their mortgage, and that's a lengthy process typically. But when there is that, and if the lenders experience some loss on the disposition of that property, generally lenders don't want to be homeowners, right? They don't want to own single-family residences. They want to give loans, and hopefully those loans get paid. But sometimes they don't, and when they don't, there's a loss involved. That's where the mortgage insurance comes and steps in, helps the lender with to mitigate losses they would otherwise have.
So, kind of recapping what you just said, MI, mortgage insurance, form of insurance, benefits the lender should the borrower not make a payment, right? Or default from not making payments.
Yeah.
And it's also my understanding that, private mortgage insurance usually is required as you start getting less than 20%, lenders would require mortgage insurance, private mortgage insurance to kind of cover that, how would I say it? I guess it's kind of like the less you put down and less skin in the game, the more risk to the loan in theory, right? That's where MI helps people get into homes with less money, less skin in the game.
Yeah. So generally for conventional loans, and those I'll say are loans sold to Fannie Mae and Freddie Mac, there are other forms of, I'll use the terms insurance, although that might not be exactly accurate when you're talking FHA and VA. But for Fannie and Freddie loans by charter, they have less than 20% down, so greater than 80 LTV. MI would be required. Also, there are many loans that are originated throughout the U.S. That are held on balance sheet or in portfolio or a depository. So banks and credit unions across the country offer loans with lower down payments, and they have the opportunity also to insure those with MGIC, and that provides that same type of protection, right? That's more of a discretionary thing. Sometimes they choose not to obtain insurance, and that might depend on their particular LTV and program. But we do insure quite a bit for independent lenders, and again, that's typically going to be banks and credit unions that are holding those loans and have kind of all the risk of loss on their own.
Oh, it's super interesting. So I assume most people buying their first home don't even know what mortgage insurance is, right? Maybe if they experience it in the first home they ever purchase, they learn a little bit about it, but the average consumer just probably doesn't know a lot about that. And your loan originator can really help you understand those concepts, how it works, how the mechanics work, and provide some advice of, when you can even get out of it. So say I had it and say my home appreciates in 5 years and I no longer need it. Does it automatically funnel off? Does it stay in place for the life of the loan? Is there how do the mechanics work after the loan closes?
Yeah, it's funny you're asking about that. I was just conversing with one of my associates this morning about some questions around this, like the cancellation of mortgage insurance. So first of all, there's the Homeowners Protection Act, which is federal and basically outlines the terms under which mortgage insurance may be canceled. And so we're of course supportive of that, and we follow that. What's interesting is that generally, so we're insuring an individual loan, right? And particularly when it's a loan that's owned by a credit union or a bank, they could cancel the mortgage insurance at any time. They're not beholden to us, right? At any time they could say, I want to cancel. Similar to you, if you want to cancel your auto insurance, assuming there's not a state requirement or some other requirement, you could go ahead and do that. So But there are very specific kind of standards outlined in the Homeowners Protection Act that kind of talk about the cancellation of mortgage insurance, as a general guideline. And this will depend on loan specifics and whether it's a owner-occupied primary residence and if it's a single unit or multi-unit property, different rules will apply. But generally, when the loan reaches 78 LTV based on the amortization schedule, then that would be the time at which it's canceled. Again, other dependencies, so is a loan paid as agreed? Is there other debt that's come in? But generally, that's kind of a good rule of thumb. In addition, Fannie and Freddie have their own guidelines around cancellation of insurance, and so we put that all together in a nice kind of multi-page brochure. And so this is a point of conversation we often have with lenders as to tell me a little bit more about how the MI works, so I can inform my borrowers and help them, when it's time to remove the MI from the loan. We also help they say the side of the MI that because of MI, you're able to put 3% down, 5% down, 10% down, even and buy this home today. Because without that, you have to wait and save.
That's great. Now, how does this is private mortgage insurance, and then we've got some government programs, FHA, VA, USDA, and those are really insurance programs in nature. Is that the way to kind of think about some of those, or how do we differentiate between the two?
Yeah, that's how I think about it without getting into the minutia as to how they differ. Essentially, they're guarantees to the holder of the loan. With Fannie and Freddie, it's a little different. These independent mortgage banker or even a bank or credit union that's selling to Fannie or Freddie, these loans all get packaged, and if they have mortgage insurance, that's really protecting the end investor, right? That's what the MI is for. And similarly with the I'll call it equivalent or similar insurance or guarantees that would happen with FHA, VA, USDA. It's protecting the investor, the holder of that loan, from the type of loss they would otherwise incur without that kind of coverage.
Yeah, no, that makes a lot of sense. Now, how does for our audience, and how does MI work in the case of a construction loan? I mean, people get MI, right? Or if I say it's a construction, a perm loan, and there's some sort of modification or conversion mechanism at the end of the initial construction term, right? So we're talking about during construction. There's situations where, hey, I can put 5% down or 10% down or even 3.5% down. I hear. How does mortgage insurance work when that initial construction term exists?
Yeah, that's a good question, and we're going to go into a little bit of detail here. So appreciate you giving me the opportunity to kind of walk through this. So in terms of how a lender would request a mortgage insurance is very similar to just a traditional purchase or even refi transaction. So through the underwriting processing, closing of that loan, they would request an MI premium quote, and then at closing, they would notify us in a certificate. During the MI application process, we would issue a certificate. Now, it would identify if it is a construction perm or a single close or a one-time close. I'll use the terms all synonymously. So it's a single close construction loan, right? Now, the lenders have options from there. When we issue a commitment certificate for that type of loan, it's a 12-month certificate. Okay? Normally, it's only 4 months, but if it's construction perm, we'll say this is good for 12 months. So that gives the lender options, and their options technically they could activate. All we've done is issued a certificate. They actually have to activate and start paying premium if they want the insurance to be in place. Okay.
When is insurance normally activated on like a traditional mortgage? Is there a comparison between the two?
On a traditional mortgage, it's activated right at closing. So they close the loan, we're notified, and the insurance is kind of in place from day one, if you will.
Okay.
Now, with the construction perm loan, they may do a similar thing, and as soon as the loan is closed, they'll notify us and we'll activate, the MI, or they have up to that 12-month period to activate the MI. Mm-hmm. And so I'm going to talk a little bit about, why you would do one versus the other.
Okay.
So if you activate up front, that does a few things for you. First of all, it provides the coverage itself, right? If you haven't activated the insurance, you can't come to us and say, well, I have a claim now that I want you to pay. Well, you haven't. There's no insurance in place until you've activated. So the insurance benefit coverage is not in place until you activate. That's the first thing. The second thing is, depending on when you activate, it can help you avoid certain requirements that you would have to do after about 180 days. What do I mean by that? So if you've not activated a loan after that insurance after 180 days, if you look in our underwriting guide, you'll see there are a few requirements. One is you need to obtain a verbal verification of employment. I believe it's within 10 days of activation. So you didn't have to go out and get that and verify that the borrower or borrowers are still employed. The second thing, you'd have to document in the file that the loan has been paid as agreed for that 6-month period or whatever it is to that date. And then the third thing would be a recertification of value. So you'd have to have typically the appraiser is going to recertify the value and make sure it hasn't declined. You avoid that. All those things I just mentioned, that is all avoided if you activate up front. You don't have to do those things. If you don't activate up front, then that's something you would need to do. With one important caveat. If you run that loan through Fannie Mae's desktop underwriter, and you followed completely the requirements of that desktop underwriter and completely the requirements of Fannie Mae selling guide, then we essentially follow suit with Fannie Mae when it's a 700 credit score or more. And this is all detailed right in Fannie Mae's guide, giving you a little bit of it here. Then we would follow suit with that desktop underwriter response, and you would not have that requirement, those requirements I just mentioned, those 3 requirements. That's only if you're kind of running that DU and fully following it. Otherwise, you would have those requirements.
Now, same thing applies for Freddie Mac as well in the Freddie Mac universe.
That's a good question. I think my answer to that, I know my answer to that is no. However, I would say read the guide yourself, but I haven't been able to find similar language in the Freddie selling guide that says, hey, you don't need to update documents for these construction loans. But those guides are hundreds, maybe 1,000 or more pages. I don't know. So there's a lot of minutia in there. And I encourage, listeners and people I'm talking to make sure you read those things yourself. So what I was talking about is the choices between activation of the MI. We're going the example of doing the upfront. So the other thing that does is because the MI is in place, that it provides you the insurance benefit. So mention that a little bit. Yeah. Now, if you have not activated, and here are reasons why lenders choose not to do that, why they choose to wait till, I'm just going to wait 9, 10 months, 11, whatever it is, until the home is done. One reason I find is that they are looking at the competitive marketplace and they've identified 1, 2, 3, whatever it is, other lenders that they're competing with for these construction firm loans, and they say, well, those other lenders are not activating the MI up front. I don't want to stand out and tell my borrower I need to collect mortgage insurance up front if they're going to multiple other competitors who are not doing it. So more of a competitive, I don't want to stand out in that way. So oftentimes that's a driving factor in choosing not to activate the MI up front. Another maybe, I hear this from time to time, is that their disclosures or their origination system or their servicing system perhaps doesn't function well in terms of at least the MI piece during the construction phase. It's a bit of a struggle. They have technology challenges to be able to collect and remit mortgage insurance during that time when the home is being built. So sometimes that's a hurdle. Sometimes they're able to sort that out, sometimes not. But that's another factor that they may think about either waiting till the home is done or activating. And the third thing I would say is most lenders I talk to just generally don't have an awareness of how the MI functions during the construction phase. Like, what if I had to file a claim during construction? What does that look like? And so if they don't have good information about that, they're not considering that in their decision. Does that make sense?
Yeah, and I want to get into that one specifically a little bit later. And I was thinking, kind of as you were talking, I was like, Well, what would the situations be? You did a great job articulating one, but I'm curious, if also, the mechanics of that loan had structured in it an interest reserve, right, where they are escrowing all the interest payments during the course of construction and essentially have pretty much guaranteed payment during that term. Would you need the MI insurance during that period of time if you've technically already holding the payments that are going to be made and you have really high confidence that you're in control of the payment process that they're going to be made?
Yeah, so just to be clear, interest reserves are generally not allowable in terms of the LTV calc piece of it. Doesn't mean you can't put an interest reserve in there. You would just essentially have to fund that. You can't fund that through the loan itself. Okay. So if you still had an interest reserve and the loan was insured, that would be fine. But to your point, if that reserve is there, it's gonna pay the loan, right, during the construction phase, unless there are extenuating circumstances where it goes well beyond when it would be expected.
So what you're saying is, hey, there's a kind of a pre-existing rule in that exists that says, hey, if you need MI on the loan, that and you have an interest reserve, the interest reserve cannot be funded, right? Or does that kind of negate the policy if it was activated? Is that?
Yeah, what it means is essentially it would be ineligible for insurance because it doesn't meet our guidelines, our underwriting guide, right? And that's generally something, if I'm not mistaken, also is the case with Fannie or Freddie. They don't necessarily say, hey, you can do a loan. Let's say your construction, I try to make it simple. Say your construction contract is $100,000. But it's $100,000. I'm going to do a 97 LTV loan, so I'm going to put 3% down. Oh, and by the way, I also have a bunch of interest that is going to be accrued during the construction phase, and I want to add that to the 97,000 or 97 LTV. I want to add that on top of my loan amount. You can't just tack it on top. You're still limited to the max loan value. If that makes sense. Doesn't mean you couldn't fund it yourself, right? If the borrower has the funds or they're other eligible sources, but it couldn't be part of the loan itself.
Yeah, that's interesting. Now I'm going to go look into that. That's really sparked my curiosity on how the mechanics work on a construction of per loan with an interest reserve and my insurance. I think that's worth diving.
Yeah, there are other like contingency reserves that are typically like cost overrun reserves, that type of thing. And generally, I think those can be part of a construction contract. I think how it generally works is if I don't know that this is often the case, but if there are funds left over at the completion of the home, which generally get applied.
Yeah. No. So what I imagine, when you think about the typical construction of perm loan, hey, you're getting financing to build the home, right? And you either got to have some significant cash reserves to pay for that because you still have to have the home that you're living in or the apartment or some sort of structure that you're living in.
Many people do, right? Yeah.
So we see interest reserves being common, but I'm just kind of curious on how it really functions and performs with MI, and if lenders even know or obtaining the MI, activating the MI, and still have an interest reserve, and those things are actually happening, but there's just no claims going that raise the red flag that, hey, this thing was in process, because there's probably not going to be a claim because the payments are all escrowed. So it may be something worth, our audience looking into themselves and figuring out, like, are we overspending?
Yeah, I always consider that. This is what I believe, right? When I think I know, but I've been wrong before. But yeah, but I am pretty confident that interest reserve part just is that's as a standalone something you can finance along.
Oh no, that's good.
Now, what I will say is certainly lenders may have their own proprietary programs that allow that. I believe that happens and maybe with a decent amount of frequency. What I'm saying is when it comes to MI itself, that would not be an eligible kind of structure.
And I can also see this situation, where they don't activate during construction for whatever strategy, and they complete the home, they get towards modification and conversion, and we just saw prices go through the roof, an appreciation of property values. They get to the end, it's like, whoa, maybe we don't do a research value to confirm the value hasn't declined, but maybe we do a full appraisal because we think the home is appreciated so much that MI may not be needed. Is that something to the strategy?
Yeah, so that also gets a little complex. If they're saying that MI is not needed, and so essentially it kind of depends on what they're doing with the loan, right? And by that I mean, again, are they holding that loan as a bank or a credit union for long term, or are they planning on selling that loan into the secondary market? And so you have to be aware of like what those rules are around that. If think of there are also considerations around like the lesser of the sales price and appraised value, right? At origination, using these, you can't just say, okay, my appraised value was more, but I have to use the sales price for LTV. And now a year later, my appraised value is still even more. That doesn't mean you can ignore the lesser out component of that, the sales price. And so that's one of the things that you want to think about. But again, if you're, to my earlier comment, if you're maybe holding that loan, right, and you have your own rules, you want to cancel the MI or not activate the cert, that's within your discretion as the lender. You're not required. Again, if you want to cancel MI, you send us cancellation notice. We'll do that. Or if you don't activate your cert, that's your choice.
Wow. I mean, it's just amazing how complicated everything gets, as you do it.
Yeah, it does.
Any kind of recommendations, to lenders that want to learn more about MI? What do you advise them doing? Like, hey, we think we're doing it the right way. We don't think we're doing it the right way. You just raised a bunch of interesting questions on this podcast. Like, what should they do in those situations?
Yeah, so we have a national sales team that covers the U.S. and we have account managers, again, throughout the country. So I would encourage listeners to reach out to those individuals. We have materials, they'll be able to kind of hopefully reiterate some of the things I'm saying, maybe give a little bit of experience of what they've seen with other lenders, share some of the collateral. And if we do need to get into a more kind of detailed technical consideration, I might get involved. We might have our claims team involved, but I feel good about saying in MGIC, my experience with others who kind of step up and help them sort that out. Ultimately, the decisions are going to be theirs. And maybe sometimes they decide something other than what I would do. That's okay, right? They're making the loans. It's their choice how they want to do MI. But I'd say you can utilize those resources throughout the country, and you can find them on MGIC.com.
Yeah, no, that's really really good to know. And I start thinking about, hey, we've kind of gone through this journey here of understanding what MI is, how it works, and some of the mechanics, and even some situational things that are involved. But if we flash forward, God forbid we get an event that, hey, a lender has a claim, right? Mm-hmm. And we stay in tune to the situation that, say we're midterm, we're 6 months into a 12-month construction loan that's going to be a one-time close. So there's that modification and conversion. Home is halfway built and something happens and the borrower's not able to pay it, whatever that may be. How do claims work? Like, you got to get the home finished. Do you take control? Do you turn everything over? You guys, hey, please go finish. What is typically involved in that process? What does it sound like? What does it look like?
Yeah, so this is not an infrequent conversation I have with lenders. And to my earlier point, well, first of all, it's pretty rare, but it does happen from time to time. When essentially, as the example you're giving is that this home is partially built and it's gone into default. And so ultimately, the first thing is, in order to file a claim, you have to go through the foreclosure process. So they'll have to be the owner of the property, the lender I'm talking about, before they could file a claim. So that always would have to happen in order for them to file a claim. Once they do that, then it would, that's where our claims professionals step in and help with kind of the processing of that. one thing that's really important to know would be that first of all, you don't have to finish the home, in order for that claim to be processed by us. The other thing would be, as a lender is kind of thinking about, how to navigate through this and what my coverage is during that construction phase. It's also important to know that the reason for default, it needs to primarily be, if not wholly be, what we refer to in our policy as a borrower credit event, credit related event. Think of that. I'll give an example, like a loss of job, something that impacts their earnings and ability to pay their creditors. What it does not cover, what our MI does not cover, is things that are related to the builder. The builder's non-performance. The builder stops building the home. The builder's not completing according to plans and specs. We're not able to get, you're sending inspectors out there to verify stuff is done and it's not done. Those types of builder, the default is driven by the builder's performance. That would not be generally covered through the mortgage insurance. So it's focused on the borrower. Okay, borrower defaults. They take property. They take the lender takes the property back. Now there's options that MGIC has. And other MIs as well. And we have options that would involve either take ownership of the home, those are at our discretion, or we pay out a claim, assuming it's eligible and met all our standards. We pay out a claim under what's called the percentage option, where we, based on the level of MI coverage they've obtained, we calculate the claim amount, or there's another option called the anticipated loss option. As you see, it's getting kind of more and more complicated. So these are the things where an account manager could step in and help and even get our claims folks and say, walk through that, and even maybe show a little math, like how that might work. But I think oftentimes lenders don't understand. It's like, these are options according to our policy and how we're insuring this that we have. And but I think the big point I don't want to lose in all this minutia is that you don't have to finish the home, right? And there's still an opportunity to file a claim and get that claim paid. And once you take ownership of the property.
This is great. I'm going to kind of recap what I heard, and I just want to make sure. First thing, and I was kind of curious about this too. Is it okay? Say we're midstream and we detected this active default. It's okay to call and start getting advice too. When these things start to happen, before we take control over the property. So before the lender would take control over the property and foreclose, or somehow, deed in lieu or whatever that situation is, the lender could pick up the phone, call, get some advice. Hey, here's our situation. Okay.
Yeah, absolutely. So yeah, either through our account manager could facilitate that on their behalf. And we have servicing folks that this is what they do, right? They've done it for decades, many of them. So absolutely walk through how that's going to work. And because, again, as I said, it's pretty rare that this would happen during the construction phase, but it could, right? And so we can help walk through that.
But, if we're designing this playbook, hey, what to do, in this situation, right? So first is call, get some advice. And then the second, really starts to formulate around the lender developing a strategy. Complete the home, don't complete the home. What does the foreclosure process look like? How willing is the borrower to, just turn over the property? Because some of that can take a long time, right?
Yes.
Foreclosure can take a long time.
Yeah.
You don't want the home, the longer the home sits incomplete, the more risk it is of not being able to be used. So say if you're at a framing stage, you don't want it to get weathered and, everything go to the ground. So protecting that asset and formulating a strategy around how to foreclose, how to take control, when to take control, how to take control, to limit their, potential, risk and liability. And when they do take control, right, that's when they're eligible for a claim, right? To actually technically file the claim. Once the claim has been filed, that's when MGIC will step in and make decisions on enforcing certain rights to the claim. Hey, you may want to finish the home. You may want to take the property. Did I get that kind of understood right there?
Yeah, so I think what we would do then is kind of explain our process once they reach out to us, or before, to your point out, before they even, if they're going kind of through that foreclosure process or deed in lieu or what have you, as they're going through that, certainly reach out and we can explain it to them. But at some point, walk them through and understand, just exactly how we would service the claim. So I think you raise a really, important point of that engagement is only going to help them. It's only going to help the lender to make sure they're taking the appropriate steps. The other thing I wanted to add here, which is not kind of well understood, is some of the additional kind of benefits of the insurance. So, to your point, when you're talking about kind of protecting the property and similar things. So, our claim payment calculation will include certain, eligible expenses that cover just beyond the unpaid principal balance of the loan. So this is all detailed in our master policy, and ultimately, we would kind of follow that and function according to that master policy. But some examples would be like delinquent interest that isn't paid, accrued but unpaid property taxes, eligible attorney's fees, hazard insurance premiums, property maintenance cost. Those types of things could be included in the claim itself. So that's like and that can be quite significant. Accrued interest and property, right? Those can be quite significant, and so that's something also that lenders should kind of consider when they're thinking about the usage of MI and really when to activate it. So.
Are there any situations, where MI would be added or you could add voluntarily, after the loan is closed? Or is that?
Yeah, generally it doesn't function like that.
Okay.
Let's say a lender has like, oh, I meant to get mortgage insurance on this loan and I didn't, or for whatever reason, I have different motivations. I want to do that now. That's a conversation we would have with the lender. And let's understand the circumstances, whether it's one loan or many loans, what's kind of going on there. And so it's very kind of specific to the need. I would say in practice, and particularly for construction permit, it gets even more complicated for construction permit. They're in the construction phase. That adds complexity. But I would say if the lender has a need or desire to obtain MI after closing, we talk to them and say, to figure out what the options might be for that.
Well, I mean, this is all really helpful. Are there any, mistakes or are there any mistakes or pitfalls you see, lenders ever making when they strategize around mortgage insurance and when to get it, when to activate it? Yeah. Are there, little trends that you see everybody kind of stumble over, or, is it really case by case?
Yeah, I think that, in terms of my experience with lenders, it's understanding that portion of how what the MI benefit is during the construction phase, and making sure you understand the considerations around to activate up front, right at closing, or to activate at the end. That's the most frequent type of conversation I'm having. One other thing I'll mention that kind of helps take some of the complexity out of the MI portion during the construction phase is we're often able to offer what I call an operational solution during the construction phase for the collection and remittance of MI. So if you think about it, during the construction phase, you're going to be building, if there is no interest reserve that you're drawing from, if you're going to be billing the borrower for, interest that's due, and there may be MI in that, you got to collect it, you got to remit it. What we do sometimes with lenders, if they want to remit, up to 12 months premium to us up front, we'll essentially hold that premium and we'll apply it each month that it's due, and it kind of gets them out of the need to handle that each month, handle that right and remit. And so we hold it up front, and then we just start, billing on month 13. And if for whatever reason the MI canceled, the loan was paid off prior to those 12 months, we would just return it back to the lender. So that's another thing that we often cover in the conversation.
That's really interesting. And when you say that, is this something that differentiates MGIC from other MI companies, or are all of these is everything cookie cutter from company to company? It's all the same, or is like specifically what you were talking about right there? It sounds like that may be a little bit different, like a differentiator between MGIC and others.
Yeah, a couple things, a couple thoughts on that for you. First of all, the master policies that we utilize are generally going to be the same. There might be a few like nuances depending on certain other entities within a different MI company. But when I'm talking about kind of standard Fannie Freddie, which are called PMERS eligible private mortgage insurer eligibility requirements, they're eligible kind of master policies. Those are pretty much consistent. Where I think we've always tried to differentiate would be this type of dialogue with a customer and helping them understand what their options are and helping them walk through all those considerations. And so kind of bringing that knowledge to a customer, and that's value, right? And hopefully that drives how they decide who they decide to work with in terms of their MI partner. So it's not so much, and the last thing I would say there is, it's hard, I can't speak to all the different nuances of how another MI company might handle certain situations if they're not specifically articulated in some type of written document, or even if they are, I might not be aware of them. But those policies are generally the same in terms of how they operationalize it. I can tell you, what I do and what we do and where we've had success. But it's hard for me to say exactly how.
Yeah, no, that's great to know. What are you seeing as far? I imagine you're probably getting a lot more calls right now regarding construction of perm loans and how does this construction thing work, especially given the massive amount of demand there is for housing and what's available. Other mortgage product, high interest rates is kind of cooling everything else off. Is that kind of a true statement? You are getting a lot more phone calls when it comes to, construction MI?
No, my experience has been pretty consistent in terms of talking with lenders about construction loans and the MI portion of it. Maybe a little bit of an uptick, yeah. And I would say, we want to make sure, again, our national sales team is kind of informed and knowledgeable about how this functions so they can look for opportunities to help lenders with that. So, maybe a little bit of an uptick. But I think it's hugely important. I imagine you do as well. Look, we're severely undersupplied in terms of housing in this nation, and one way to deal with that is to build more houses, right? And to the extent we can do that with the 3%, 5%, 10% down, which we can, right? That provides more opportunities than there would otherwise be.
Yeah, no, I love the idea of MI on a construction of perm loan. I think it just provides a lot more opportunities for people to get into homes. At the end of the day, that's the goal here is home ownership, and being able to build a really well managed construction loan program and being able to expand that program so it can be offered, to more people. This helps really kind of protect that safety and soundness, helps protect the lender and where people can't make that payment. And I just think it's an amazing, part of this universe, construction lending universe, you can call it, that has just great benefits, helps them mitigate that risk. Any other trends that you see happening? Are there any industry trends or regulations or things that are happening in the MI space that our audience should be aware of?
Yeah, I mean, there's stuff always happening, right? A couple things in particular that we've been paying attention to is recently this NAR, National Association of Realtors settlement that has to do with cooperative compensation and how listing agents and buyers agents are being paid. So we're paying close attention to that. We talked another group later today about that. There's another one that, again, gets a little technical and detailed, but it has to deal with what's called Basel III, and that has to do with how banks hold capital, in their institutions and the standards they're in, and that affects, mortgage lending as well. So there's some, interagency regulatory proposals around that, and there's some impact to MI. So it's important to us in our business that we're kind of attuned to those things. Neither of those, I'd say necessarily are going to directly impact, construction permit loan. Could be a little bit impact on that latter one relative to capital and holding capital and ensuring. That is probably a whole another hour session, and maybe this isn't the platform for that. But those are a couple things that have been percolating here for a little while.
Yeah, it'd be great to see some construction lending be exempt under those capital requirements, especially if it's consumer related. It would make a lot more sense of these capital requirements. But no, that's great to know. And Kevin, I can't say thank you enough for all this valuable information. And I know for myself personally, I've learned a lot about MI and feel a lot more comfortable understanding some of the key concepts and mechanically how it works. So thank you very much. I'm sure everybody else is thinking the same thing. As we near the end of the podcast, we have this section called called rapid fire. Right, and I'm just going to shoot off a couple questions here for you. We do this at the end of every podcast, and if you're ready, I'm going to go ahead and
please fire away.
All right, recent book or movie that you've read or watched that you would recommend to somebody else?
Yeah, so the book thing is not coming to me, but we would. The actual title of it, but the idea of it is around that. Sort of the idea around it is, business has been so focused on data, gathering data, understanding data analysis, right? And this book talks about the importance of intuition, which doesn't mean we ignore the data, but intuition can be very valuable. I think of it, I'll send you the name, but I did just watch actually on Netflix the Ripley series, which I found particularly interesting, kind of how it was shot.
Talented Mr. Ripley recreation.
Right.
It's like a redo of,
yeah, it's a redo of that. That movie was that movie's quite old now, I think, but it's a redo. I think it's six different segments and probably 45 minutes to an hour each. But I found it quite interesting, particularly just how it was shot. And there's a lot of lack of dialogue and kind of visual interest in it. So it's maybe something new for listeners to check out.
I saw that on there and I was like, ooh, we gotta watch this one.
It requires some patience, right? You have to be kind of patient with it, but because it's not, there's not bombs going off. Right? It's interesting dynamics between people.
I think you would like the 3-body problem. I think if you like that one, then I think you've got to check out the 3-body problem on Netflix. It's kind of a mind-bending start of the series. All right, second question. Recent product that you have discovered that you would recommend to somebody else? And I love this question because I'm always learning about people with this question and exciting things that are out there. But I always use my example of my Ember mug, right? It keeps the temperature of my coffee the exact same temperature all the way through. Yeah. These guys should give me some sort of royalty for the amount of recommendations I have on this mug. But something like that you recently discovered that you recommend to others?
Yeah, so I'm using one right now. It's not kind of a home run, but I have this little light, this little halo light. It's only about this big, and it just helps to light up a little bit. I don't want too much light, but or if you're on, whether it's just whether you're having a Teams conversation or Zoom, and it's portable, and you just kind of plug it in, and you're not having to lug something big around. So it just helps a little bit with the lighting on Zoom calls. So that's one thing I've started to use, more frequently.
No, I love those. It took me a while to figure out a good lighting setup, but nothing better than that. Now you see a lot of the AI stuff that kind of kicks in. It's like, oh, I'm going to adjust your temperature. adds up. So it's just get better every day. All right. Now, one of my favorite questions I like to ask is, if you haven't already built your own home, would you ever consider building your own home?
I'd say yes to that. I would, but I would also think about what else I have going on in my life at the time, and be realistic, of course, about things like budget. But I think to the extent you're maybe don't have 2 or 3 kids, or big things kind of going on with your life. But that's just me. Some people kind of are, a little bit maybe more able to kind of juggle all these things at once without causing undue stress. But I certainly would, but I want it to be kind of the right time for me and with my wife for us to think about taking on something that big.
Did you ever do any sort of remodel or improvement during the pandemic?
I'm trying to think. I tinker with things, on my own, frequently. Build big projects. We did acquire a vacation home during the pandemic, so that brings on its own, different complexities there. It's a water, it's on a lake, so when you're talking about, okay, now I got to think about maybe a boat and all the other things that go with that. That was enough, right? Without taking on big other projects to the dwelling itself.
I can only imagine on that one. That sounds like it'd be a lot more enjoyable than taking on a remodel or something. Last question here. With respect to the mortgage universe, if you were able to snap your fingers and change one law or regulation or guideline or requirement, which one would it be?
It's hard for me to pick one. I think that sometimes we struggle a little bit with complexity, and there's no magic wand. And I think about consumer regulations and how difficult it is to navigate those things. I think what I see lenders often struggling with is just clarity on what's required of me and how to execute on those things. And I think that would help lenders in general. So maybe the general oversight and regulatory requirements around lenders being a little bit simplified, I think that would go a long way. I think, I don't mean to say consumer protections are important. They absolutely are, valuable. It's just how to construct those things and how to actually effectuate those is probably have some opportunity.
No, that's a great answer. Great answer. Well, Kevin, it has been an absolute pleasure having you on the podcast. If people want to get in touch with you, what's the best way for them to reach out and find you?
Yeah, feel free to email me directly. It's Kevin_Hearden, HEARDEN at MGIC.com. Or if you're talking with your account manager and you'd like to have a conversation, I'm happy to do that as well. So I appreciate your time. I hope we got into some granularity here. I hope it was interesting enough and useful enough, and every student's not.
Oh, definitely interesting on my end, and I know our audience would really appreciative of all this great information. We're going to go ahead and include all of your contact information with the podcast. Absolutely fantastic having you on there. We hope you join us again in the future. But Kevin, thank you so much for joining the podcast, and really appreciate you being on here.
Thank you. Very glad to do it. Have a great day.
This podcast is intended for educational and informational purposes only and does not replace independent professional judgment. Land Gorilla Inc. makes no representations, warranties, or promises for and disclaims any express or implied warranties related to content. Before acting on any information, you should consider the appropriateness of the information as it pertains to your unique business needs.